There is this really legendary story about Vince Lombardi.
Oh, yeah, the football coach.
Exactly, one of the greatest of all time. So he walks into his very first training camp with the Green Bay Packers. And he stands in front of this whole room of, seasoned professional athletes.
Right, guys who've literally been playing the game their entire lives.
Exactly. And he just holds up a piece of pigskin and says, "Gentlemen, this is a football."
I love that story. It's so good.
Right. Because even professional athletes still have to practice the basics. Because the fundamentals, they really dictate the high-level strategy.
Yeah, you can't run advanced plays if you don't know how to catch the ball.
Exactly. So today, we are taking a page right out of Lombardi's playbook. Our football for this deep dive is the 1031 exchange.
Ah, the classic 1031.
Yeah. We are drawing on a really comprehensive guide by commercial real estate expert Michael Linton. And look, if you are listening to this, you likely already know what a 1031 is.
Right, you're not a beginner.
No, you're not. So we are here to relearn basic definitions. We are here to look at the exact statutory mechanics of why it works, so you can exploit it at a much higher level.
What's fascinating here is why mastering these specific mechanics matters so much. I mean, this isn't some trendy financial life hack or a temporary loophole.
Right, it's not a TikTok trend.
No. Exactly. The 1031 exchange is statutory law. It has been baked into the U.S. tax code since 1921.
Wow, 1921. That is a long time.
Yeah, over a century. And investors who truly understand how to wield it, who respect the friction points and the underlying intent of the law, they can permanently alter the trajectory of their family's wealth.
It really is that powerful.
It is. It is the dividing line between simply, managing assets and actively building a multi-generational empire.
Okay, let's unpack this.
Yeah.
Because I want to jump straight into the foundational mechanic of this tool. The baseline definition is selling an investment property, rolling the proceeds into a replacement property of equal or greater value, and deferring federal capital gains taxes.
Right, that's the textbook definition.
Yeah, but I want to zero in on that word deferral.
Yeah.
Because we hear tax deferred, and human psychology almost automatically translates that to tax-free.
Oh, absolutely. And that is a huge mistake.
Right. I like to think of tax deferral sort of like a snowball rolling down a hill. You sell a property, roll the money into a new one, and the snowball just gets bigger.
It gathers mass.
Yeah, exactly. It gathers mass. But the actual tax bill you owe, that is like a rock hidden right in the center of the snowball.
That's a really good analogy.
Thanks. I mean, it is traveling with the property. The rock hasn't just magically disappeared because the snowball got larger.
That is a highly accurate mental model. The IRS is actually incredibly explicit about this distinction.
Are they?
Oh, yeah. Specifically in IRS Fact Sheet FS 2008-18, they state plainly that taxes are postponed, not forgiven.
Postponed, not forgiven.
Got it. Right. The government is essentially saying, hey, we will allow you to keep working with our money. We will let you keep it invested and compounding in the economy, but that internal liability remains on the ledger.
But wait, if that tax rock is always inside the snowball, when does it, finally hit the bottom of the hill and shatter?
Well, that's the big question, isn't it?
Yeah, because the conventional wisdom is that you just keep rolling it until you die. I hear people talk about this generational wealth endgame all the time.
Sure, swap till you drop.
Exactly. But does the IRS genuinely just let you hold that deferred tax liability until you pass away and then forgive it? That feels like a massive oversight by Congress.
Well, it isn't an oversight at all. It is a very deliberate feature of the broader tax code.
Wait, really? Deliberate?
But under current law, if you hold that property until you pass away and it transfers to your heirs, they receive what is called a stepped-up cost basis.
Okay, stepped-up basis. Break that down for me.
So the IRS recalculates the property's baseline value based on its fair market value on the exact day you die. Oh, wow.
Right, rather than what you originally paid for it or whatever your adjusted basis was after all those 1031 exchanges.
So they just wipe the slate clean entirely.
Yep, the slate is wiped clean.
But why hasn't Congress closed that? I mean, why allow all that deferred gain to just evaporate entirely? It seems like they're losing out on so much money.
Because the alternative creates a complete administrative nightmare and, honestly, severe economic stagnation.
How so?
Think about it. If heirs inherited the original cost basis from, decades ago, no one would ever sell inherited property.
Oh, because the tax hit would be astronomical.
Exactly. It would be catastrophic. Capital would just be locked up forever. So by offering the stepped-up basis, Congress incentivizes the next generation to either sell the asset, thereby generating economic activity, or continue operating it with a clean slate.
That makes total sense. So your heirs inherit the asset, that internal tax rock just dissolves, and the 1031 strategy achieves its ultimate terminal victory.
That's exactly it. That structural design is incredibly powerful. But to really grasp the velocity of money we are talking about here, we need to look at the sheer scale of the tax liability you are avoiding during your lifetime.
Oh, the numbers are staggering when you actually map them out.
Let's do that. Let's
Yeah.
look at the math from a real-world scenario in our sources. We have an investor named Sandra.
Okay, Sandra.
Yeah, so Sandra bought a retail strip center in Chicago about 12 years ago. Let's just skip the elementary math of her purchase price and capital improvements and look straight at the impact today.
Right, keep simple.
So today, she has an adjusted cost basis of $362,000. And a developer comes along and offers her $1.2 million for the property.
Which leaves her with a massive realized gain of $838,000.
Exactly. Now, if she just cashes out, the standard tax system kicks in. And this is where the agony really happens.
Yeah, it gets painful.
We aren't just talking about a 20% long-term capital gains tax plus the 3.8% net investment income tax. The real killer here, the one people forget, is depreciation recapture.
That is the hidden trap door for most investors. They totally forget about it.
Why is it so bad?
Well, over the 12 years Sandra owned that property, she took significant depreciation deductions to lower her annual income tax.
Right, which you're supposed to do.
Exactly. But when she sells at a massive profit, the IRS steps in and demands those tax breaks back.
Ouch.
And that depreciation recapture is taxed at a brutal 25%.
Wait, 25%?
Yes. So when you combine the capital gains, the net investment income tax, and the recapture, Sandra is looking at writing a check to the federal government for somewhere between $220,000 and $240,000.
Oh my gosh. Which is capital that simply vanishes from her portfolio.
Yeah.
I mean, the compounding effect of losing $250,000 is just staggering.
It ruins the whole wealth-building trajectory.
But if she uses a 1031 exchange and buys, say, a $1.3 million industrial property down in Asheville, her federal tax bill today is zero.
A flat zero.
The lost opportunity cost is completely neutralized. She now has an extra $220,000 plus acting as a permanently working asset in her Nashville property.
Generating rent and appreciating year after year.
Exactly.
It functions almost like an interest-free loan from the government, supplied directly from the taxes you would have otherwise paid.
That is wild.
That is the true engine of the 1031. It's the uninterrupted velocity of your own capital.
So the government is effectively landlocking your wealth by demanding you keep it in play. But they also dictate how it stays in play, don't they?
Oh, strictly. Very strictly.
Yeah, because you can't just take that $1.2 million and buy a yacht.
No yachts, no.
The foundational test here is called investment intent. The property must be held for investment or for productive use in a trade or business.
Which means the quick fix and flip you're working on or the beach house you mostly use yourself, those are completely disqualified.
Why is the flip disqualified? You're making money on it.
Because the IRS evaluates your primary motive. With a fix and flip, they do not view that as an investment. They view it as inventory.
Ah, like a product on a shelf.
Exactly. You are acting as a dealer selling merchandise, not an investor holding an asset. The intent is strictly scrutinized.
But the definition of what qualifies used to be much broader, right?
Way broader.
Because there was a massive structural shift with the Tax Cuts and Jobs Act of 2017. People used to do N10 and 31 exchanges on artwork, heavy machinery, corporate jets.
Yeah, farm equipment, you name it.
I mean, you could theoretically trade a Picasso for a Rembrandt and defer the taxes. Why did Congress suddenly slam that door shut in 2017?
It really came down to balancing revenue generation with economic stimulus.
Okay, how so?
Well, the 2017 Act made sweeping cuts to corporate and individual tax rates. To offset the cost of those cuts, Congress needed to eliminate certain tax expenditures.
So they needed to find money somewhere.
Exactly. So they removed personal property from Section 1031, restricting it entirely to real property dirt and the structures attached to it.
Dirt and structures. Got it. But why protect real estate and not art?
Because real estate transactions have a massive localized economic multiplier effect.
Oh, interesting.
When a commercial building changes hands, it triggers spending on title companies, brokers, contractors, environmental inspectors, local municipalities. A corporate jet or a painting simply does not have that same downstream economic impact.
That makes a lot of sense, actually. The government protects the vehicles that generate secondary economies.
Precisely.
And to that point, they also enforce a strict geographic limit. The tax code is strictly domestic. You cannot trade a warehouse in Chicago for a beachfront resort in Mexico and defer U.S. taxes,
No, absolutely not. The capital must remain within the United States tax jurisdiction.
which forces the capital to continue circulating within the American economy.
That's the whole point.
Right. Well, here's where it gets really interesting. If you are listening to this, you already know that the term like-kind is a massive misnomer in the tax code.
Oh, it confuses everyone.
Yeah. You know you don't have to trade an apartment building for another apartment building. You can trade vacant land for a residential rental or a boutique hotel for a portfolio of self-storage units.
As long as it's real estate for real estate.
Exactly. But what is truly fascinating is how investors are utilizing this broad definition to pivot out of active management entirely.
The DST strategy.
Yes. How does something like a Delaware Statutory Trust, or DST, even qualify as real estate under these rules? Because to me, a DST sounds like a financial security, not a piece of dirt.
That is a phenomenal question because you're right. It sounds like a stock or a mutual fund.
Right.
But a Delaware statutory trust is an entity used to hold title to investment real estate. A sponsor acquires a massive institutional-grade property, say a $50 million Amazon distribution center, and packages it into the trust.
Okay.
When you, the investor, use your 1031 exchange funds to buy into the DST, you are purchasing a fractional beneficial interest in the trust itself.
So I don't own the whole building.
No, just a slice. But because of how the IRS has ruled on the specific legal structure of DSTs, purchasing that beneficial interest is treated exactly the same as buying a direct fee-simple interest in the underlying real estate.
Oh, wow. So the IRS doesn't view you as buying shares of stock in a company. They view you as literally owning a fractional slice of the physical concrete and steel.
Precisely. And the best part is, the sponsor manages the property entirely.
So no midnight phone calls.
Exactly. You collect your pro rata share of the rental income, and you have zero management responsibilities.
This completely solves the landlord fatigue problem.
Oh, it's a lifesaver for so many people.
Because if you spend 30 years plunging toilets and fielding late-night phone calls from tenants, you might feel trapped by your own success.
Very common.
Selling outright means triggering a massive tax penalty. But a 1031 into a DST allows you to transition your entire portfolio from an active, high-friction job into a purely passive income stream, all while keeping your tax deferral intact.
It transforms the 1031 exchange from a simple tax deferral mechanism into a really dynamic portfolio repositioning tool. You can pivot asset classes, change geographies, and alter your entire lifestyle without notifying the IRS with a giant tax check.
Man, that is cool. But doing that requires navigating a timeline that seems almost aggressively designed to trip you up.
It is notoriously strict.
Yeah, the IRS is essentially giving you an interest-free loan here. But from looking at the code, they are incredibly paranoid about you holding the cash or having too much flexibility. It seems like the entire timeline is rigged to force your hand. We really need to look closely at the clocks.
The clocks are absolute, and they are the #1 reason exchanges fail. They both start ticking the exact same day, the day after you close on the sale of your original property.
Okay, so the first hurdle is the 45-day identification rule. Within 45 calendar days, you must formally, in writing, identify the exact address or legal description of the replacement properties you intend to buy.
Yep, 45 days. It goes fast. Super fast. Now, the most common method is the 3-property rule, where you simply name up to 3 targets of any value, and you only have to close on one of them.
Very straightforward.
But there is also the 200% rule. If you want to identify more than 3 properties, you can, but their combined total value cannot exceed 200% of the price of the property you just sold.
Right.
Why does the 200% rule even exist? It seems overly complex for a standard investor.
Well, it exists because institutional investors and syndicators buying massive portfolios, they need a mechanism that the 3-property rule just cannot accommodate.
Oh, because they're buying so many properties.
Right. If an institutional fund sells a $50 million office building and wants to exchange it for, say, 20 smaller retail locations across the Midwest, limiting them to identifying only 3 properties would make the transaction impossible.
That makes total sense.
The 200% rule allows them to identify a long list of smaller assets, provided the aggregate value stays under that 200% ceiling. It provides scalability. That completely changes the strategic approach depending on your scale. But regardless of which identification rule you use, you are then running straight into the 180-day completion deadline.
The final buzzer.
Exactly. You must close on your replacement property within 180 calendar days of selling the original one. But there is a massive trap buried in this rule that catches people off guard.
Yes, there is.
The deadline is 180 days, or the due date of your tax return, whichever is earlier.
This is huge. If we connect this to the bigger picture, you have to look at the calendar.
Okay, walk me through it.
Think about an investor who closes on the sale of a property on November 15th.
Late in the year, okay.
Right. If you count forward 180 days, their deadline should land somewhere in mid-May of the following year.
But tax day is April 15th.
Exactly, which means April 15th arrives before day 180. If that investor simply lets tax day pass without taking action, their exchange period abruptly terminates on April 15th.
They just lose an entire month of their timeline.
They do. The only way to preserve the full 180 days is to file IRS Form 4868 to officially extend their tax filing deadline.
Wow.
If they forget to file that extension, the clock stops immediately, the exchange fails, and the massive tax liability becomes due.
That is a terrifying bureaucratic landmine. And let's be absolutely clear for everyone listening, these deadlines are carved in stone.
Granted.
Yeah. Your lender dragging their feet, the IRS does not care. The seller on your new property backing out on day 44, too bad. Unless you are geographically located in the middle of a federally declared natural disaster zone, there are 0 extensions.
None.
Which means you must be actively hunting for your replacement asset or lining up your DST investments before you ever close on the sale of your current property.
Waiting until closing day to start your property search is essentially guaranteeing failure. You have to be proactive.
Okay, but even if you execute the DST strategy perfectly and you beat both the 45-day and 180-day clocks, there is still the baton pass problem.
Ah, yes, baton pass.
The 1031 exchange is fundamentally a financial relay race. You are selling property A and buying property B, but you are legally forbidden from ever holding the baton.
You cannot touch the money.
Right. If the proceeds from your sale touch your personal bank account, your LLC's operating account, or even your attorney's escrow account for a fraction of a second, the IRS calls it constructive receipt.
And it's game over.
The exchange is instantly disqualified and there are no do-overs. So how do you actually transfer the capital without touching it? I mean, I can't just wire $1 million to a stranger and you just said my own lawyer can't hold it.
That's where the tax code mandates the use of a qualified intermediary, or QI.
QI.
And the rules regarding who can serve as your QI are strictly about preventing that constructive receipt. The IRS disqualifies anyone who has acted as your agent, so your attorney, your accountant, your real estate broker, or your employee in the 2 years prior to the exchange.
So you really can't use your buddy.
No. You must hire an independent, specialized professional.
So you really are trusting a completely independent third party with your entire liquidity event. You hire them before closing, they step into the transaction, take the legal assignment of your contracts, receive the funds directly from the title company, and then use those funds to purchase the new property on your behalf.
That is exactly the workflow.
But how do you vet a QI? I mean, if they are holding millions of dollars of your capital, what happens if they go bankrupt or commit fraud?
Well, that is the nightmare scenario. Because if the QI loses your money, the IRS still considers your exchange failed, and you still owe the taxes on the money you no longer have.
That is brutal.
It is. So vetting is critical. You must ensure the QI holds your funds in segregated dual authorization bank accounts rather than commingling them with other clients' money or operating funds.
Okay, so a separate account just for you.
Right. You also want to look for QIs that carry robust fidelity bonds and errors and omissions insurance. And you want to make sure they are members of industry watchdog groups like the Federation of Exchange Accommodators.
Got it. So what does this all mean? Let's bring it back to the Lombardi fundamentals for you. The 1031 exchange is not a loophole. It is a meticulously designed statutory framework.
Exactly.
It is tax-deferred, not tax-free, that tax rock travels with the property. The asset class flexibility is massive, allowing you to transition from active management into passive fractional ownership via DSTs, provided you stay within the U.S. borders.
Keep it in the U.S.
Right. The 45-day and 180-day clocks are absolutely merciless, requiring proactive strategy, and you absolutely must deploy a vetted, independent, qualified intermediary to entirely avoid constructive receipt.
It's a lot to manage, but it's worth it. And this raises an important question, actually, a really profound philosophical puzzle to chew on.
Okay, back up a little.
When you look at the terminal velocity of the 1031 exchange strategy, The goal is to endlessly defer these massive tax liabilities until death. Only then does the stepped-up cost basis finally wipe the slate clean for your heirs.
Right, the ultimate victory.
Right. So does utilizing the 1031 exchange fundamentally alter how an investor views mortality and inheritance?
Oh, wow. It effectively turns a standard commercial real estate transaction into an untouchable, multi-generational pact.
It really does. You are constructing a financial architecture where the ultimate victory, the actual permanent erasure of the tax debt, can only be fully realized when the original architect is no longer around to witness it.
That is deep.
You are quite literally building an empire designed to be completed by your absence.
That is a heavy and completely fascinating way to look at wealth building. You're playing a game with rules that outlast your own lifetime. Gentlemen, this is a football. Now it is up to you to decide how far you're going to run with it.